Okay. So accounting, sorry, general ledger accounting, electronic processing, evaluate, define valuation area. We were in valuation methods and valuation area. Let me revise that. You have multiple currencies the company is transacting at. You say, okay, we have AED. Okay, from AED you want to do USD, pound, euros. You do the transaction, and the money is transferred into another currency. The period end comes, month end and year end. So you recognize, okay, what's the realized and unrealized gain and loss? You are familiar with that? And unrealized gain and loss. Oh no.
I know the name realized and realized.
Okay, let me explain that. There are three things. There is realized and unrealized revenue. There is realized unrealized income. That's different than revenue. Income and revenue has a very, people don't understand, but there's a difference. Then there is realized and unrealized expenses. What's the difference? When we say realized means it actually came into our account. For example, we have receivables. You have actually received the cash with you in the system, in your capital account. That is your realized. You have the receivables that you have, the amount that you are yet to receive. Okay, if for example you did the period end and year end, at that time the existing US dollar receivable, there was a difference, there was a gain. So you will record that in unrealized revenue. But the US dollars you have in your bank account, that is your realized. That is your realized gain because you actually have that with your within your system with you. It's in your possession. The receivables is not in your possession. Okay, this is the difference of realized and unrealized. Okay. Similarly, just a moment. Sorry. Similarly, in a similar case, what's important is you have the revenue, of course, realized and unrealized, and it's the sales happened, the expenses occurred. The expenses that you know that okay are actually happening and happened in the system, those expenses are your realized expenses. And if you have expenses that you have accounted for, we call them deferred expenses. Those are unrealized. In the case of income, you know that there is specific interest income coming in and in future dates, or you have some investment in the bank, okay, and profits are coming in. They are yet to come. It's a US dollar deposit you have, okay. They're yet to come. So if they are yet to come, then for that you say unrealized. If they are already there, the amount that you have in your deposit, if it has changed the value already, that is your realized. The only difference you need to remember is something that you have in your hand is realized. You do not have in your hand, it's unrealized. Why did they change? You know why there's a standard for revenue recognition, IAS 18. They have changed to IFRS 19. Why? Why did they change it? The revenue recognition standard. Why did they do that? They changed it because there was a problem. Companies were conducting fraud. How? What they were doing? Well, sorry, I didn't share this. My mistake. Sorry, my severe mistake. Sorry. Okay. When the companies they had some, what can I say? They had some revenues coming in. What they did was they actually played with the books and gave dividends and conducted IPOs on their unrealized revenue. Now, there is a big problem going on in the world. Let me tell you that. The world is very happy that so many IPOs are happening, so many, you could say, companies are growing up and giving, grow as a startup, you can grow. Do you know what what the fact change is? If you want to have realized If you have someone committing you that, okay, I'll give you $10 million, he hasn't given you that. He signs with you that he will give you that. He signs a contract. In the US, it's legally binding, but in IFRS, it's not. You cannot do IPO, you cannot do dividends, you cannot do revenue share on something that you do not have in your accounts. For example, a company says, we want to convert the currency. You know bonds? Bonds, BONDS, bonds. Are you familiar with it? Money bonds we have, corporate bonds, and we have the shares and bonds, okay? I'm talking about currency bonds. Currency bonds are legit. Currency bonds issued in the company name are actually their asset, okay? We call them noted items. They're part of that. So, if a company says, okay, we have raised this much capital, you have heard in the news, this company raised this many million. Now, what does that word mean? The company is existing in US. Okay, so in UK, if you say raised, that means that money was transferred to his account. In US, we have gap, and the gap is not. You could say not much realization. What they do is they commit to the person, then they call their bank. Okay, I'm issuing a credit line in the name of this person under my account. Release this much credit for him, and whenever he requires, direct debit my account. That's not actual revenue. The problem is when you do that, when you start doing IPOs and issuing dividends on your unrealized capital, that actually makes a big problem. Why? You see, the share capital that you have in your company, that share capital has a nominal value. Okay? When you raise the value, when you want to change it, IFRS says, where's the revenue? Do you actually have the money or not? We can't play with paper. That's when they switched the standard. Now in the US, this is not the case. The gap is there. So they are not following that, and they can reckon if some person commits not actual revenue but real, like, okay, I will give you that. It's committed on a contract. It's fine. Okay, government says, okay, he's committed. He has given, although the transaction hasn't happened. As the IFRS says, the transaction is supposed to happen. The actual revenue you have in your account, that's what you can use. That's the difference. So what we are doing here, we are doing foreign currency calculation in the system where we're saying, okay, we have US dollars, we have euro, we have pound, we have AED. Now the transaction is happening in the system. What's going to happen? We can say, okay, we had $100 or $10,000 transaction happening. We had the $10,000 transaction happening in the system. We have the $10,000 in our bank account. Then we have a receivable of $5,000. These valuation methods, what they will do, each currency you have, you can create a separate valuation method for that. You have the option. Okay. Once you have that, you have the valuation area per currency you can manage. Otherwise, you can have single valuation area. I told you with multiple currencies, you can manage that. If you want to have one valuation area, you can have that. You have the transaction. What the system will do, at the back end, there's an exchange calculation, exchange settings. We go to a web platform. In some SAP releases, you will see it says SAP NetWeaver. It used to be called that. Now it's called ABAP platform. First, it used to be called SAP NetWeaver. You will see this word also in some systems. In some online videos, you will see that. Okay, because it was the old name. General settings. We go to currencies. In currencies, we see, okay, we have this, and there it is. Enter exchange rates. We go inside. We have the exact exchange rates per date, per the exchange rate type that we have. We are using M. For all the transactions in SAP, we use the M type. So we enter the rate for M, or the buying selling rate, BG, like that. We enter that and we say, okay, this is the rate. We assign that in the valuation area, in the valuation method. You saw that yesterday. Once we assign that, when the closing happens, the system starts posting the gain or loss in the specified accounts, the code automatically. The system says, okay, it's realized revenue or it's unrealized. In the money we have in our account is our realized one. The money that we have in receivables, that's unrealized. We take them both and we use them. That is what it's about. That is what realized and unrealized is. So in the system, we say, okay, we have this transaction going on, we have this transaction in place. We want this transaction to happen in this manner. Of course, it will happen. Not a problem. It will happen. But we have to account for the gain and loss. For the gain and loss, we will specify the account. But this is how the logic works. The money that you have with you in foreign currency, that's realized. Whatever is in the receivables, no, it's not. Even if you have in payables, that also accounts for that, receivable, payable, all of that. Even the liabilities in foreign currency, they also get. So all of the things are accounted for. So everything gets recorded in the gain and loss for the specific currency because the total values are existing and we have to record that. Did you understand the concept? Okay. IAS 21 is the standard. Okay. Okay, we have a concept of spread. Spread is a difference between two average rates, and we have the exchange rate types you can check. We keep translation ratios 1:1 for all currencies except for pound, dollar, and euro because they have the ratios of points. So we can use that. Otherwise, for all currencies, we keep ratio 1:1. Then we have prefixes. The prefix for direct is asterisk. For indirect is forward slash. We call it the forward slash. It's an interview. It can be asked in the interview, in the certification, so it should be known. What is the sign for direct quotation and indirect quotation? So once we do this, we move forward. Now we have decimal places. We can set up the decimal places. We could have per currency. We have AED, 3 decimal places. Close this. Now let's go to, again, we assigned the valuation area to accounting principle, everything done. Delta logic, I told you, the system will automatically run the foreign currency valuation every month. So it's a choice. We go here. Now we begin our accounts. We did the KDB yesterday. BXRG, we did these yesterday, you remember? In yesterday's class, we did these accounts. You don't remember? We will do KDF, but we did KDB. You don't remember? Yesterday we did this. You were here, rolling valuation, gain and loss. We discussed gain and loss on rolling valuation. We discussed the expense account for P&L. We discussed the gain and loss account. This isn't part of the P&L statement. This is also part of that, but it's internal. This is the actual one for reporting. You remember? Yeah. We did this. Now we are moving from, I said we have done KDB. Now we are doing KDF. Okay. It's a longer configuration with KDF. So we have these, and go here and let's begin. GL account. Now we have to create a two GL accounts also. Let's begin. We select this. For input and text category. Here we change it in this one, all output text. Why? We will only allow output text value with the customers, not the input text. Input text is with vendors. Okay. So we select this, then we go here and we select this. Reconciliation ready for input and field status group. We have the reconciliation. So to select this one. Enter and save. We have to create another one. I'll make a copy of this and 62 description, and we change it. Accounts payable. We select this, we change it to vendors, we open this, we go here, press enter, we go inside of it, and we save. Let's begin. We can begin with one, and we will now what these are. We have to define the gain and loss accounts, okay, and I will tell you how to appropriately create them and everything. Let's begin. This one, currency AED, company code currency. If we have a group, then we will select 30. Otherwise, it's the same. We have one company, so company code. If we are doing consolidation, then it's 30. Otherwise, if it's a conglomerate, remember again, then we select this one. Conglomerate means group of groups. Means in Coke, or sorry, in Unilever, it will be 60, because Unilever is part of multiple. So let's begin. Exchange rate difference realized. Now let's begin. We have defined this. Now we begin. Okay, let's begin. Now we are going to create specific accounts. We have these. Now I will be creating with reference. The numbering sequence I'm using, it's not fixed. You can make up from your mind. In a live implementation, or as an accountant when you will go in the company, you have to ask 3 questions always. But in the interview, they will stress about the salary. You have to focus on the fact saying, no, sir, I'm more interested in how the work is and how your organization is. I'm more keen to learn about that. Number 2, when you will enter the office, you will be more interested in how their system is working. You look at their chart of accounts. Number 2, you look at their GL reports. Okay, I will tell you the TCO for that. And then number 3, you will ask them how the system is overall designed from one section to the other. Okay, I will be covering a lot of things because I have to build an accountant out of SAP. So a lot of knowledge is coming. So in the videos, we will cover this at a rapid speed so that you will have the video, but I will be covering a lot of information. So you will have to see the videos again and again. Of course, it's your choice, but I will be covering a lot. So that I make sure that when you enter the market, if you want to get a job, you get as per the requirements of the market, and you will have to distribute or circulate your CV in mass to get a call. Okay? And my advice, if possible, do start learning Arabic. It will increase your chances. It means by 80%. As a woman, you can very easily navigate and start making friends in Emirati women. Emiratis have communities in Sharjah. Become a member of Emirati UAE culture, Middle East, all these. You have those societies. It will be easier for you to navigate. Very, very easy. Let's begin. Exchange rate difference realized, and See, this is loss and this is gain. This is loss. Now we're just quietly creating many accounts, so just observe what I'm doing. Valuation loss 1, 2, and then we have the adjustment account. Okay. I'm using just a non-chronological pattern. Balance sheet we created here. Just a moment. Okay. Okay. We have none, so in that case, we will select this one only. Okay, sorry, I will just stop. Okay, translation. What is means? Valuation is about the gain and loss. The translation is like if it's you see translation ratios. I just showed you in a few moments ago in the currencies we had translation ratios 1:1. You saw the screen. Those translation ratios are posted into these accounts. Okay, between the currencies. Because those translation ratios will actually affect the spread. So if the ratio 1:1 is there, then the spread value is there. If ratios change, then it is multiplied with the spread. Let's begin. We go here. Start. Now what we do, we just copy and recreate for payables again. Copy as and we change the account. And save. So the configuration is complete. This is the standard one we don't use. In alternative, if the company wants to use alternative currency for transactions, this is that for intercompany transactions. In the case of a group, means the head office one currency is used by two company codes within a single group. Understand the situation, right? If it's a group of companies, we have head office currency, and then we have two companies that are subsidiaries of that main company. So those two companies will not transact in their currency, they will transact in the head office currency. That is the concept of alternate currency within the group. That's the concept is intercompany reconciliation. What is intercompany reconciliation? It's a question. Remember, in the interview, it will be asked. Intercompany reconciliation relates to the fact that if you have a company in one place and you have another company within the group, you do the transaction, and if there is any transaction between them, any sale, anything, then we record a sale in one, a receivable in one, and a payable in one. But they cancel each other out. Yes, because it's part of the group. The money is already in the group. In the final financial statement that you prepare, you will record internal liabilities and assets, but the values will be zero. You understand my point? That's what it is. That is what is called intercompany reconciliation. You should set it out and you should study it in detail before the interviews. It's a question. What is intercompany reconciliation? Then what is bank reconciliation? What is business partner, or what is supplier reconciliation? What is customer reconciliation? What is a foreign currency valuation? Okay, what is inventory valuation? All of that. These are the questions that are asked. And also, you should be familiar with the IFRS. I will send you something. You should study it also. You like studying books? You can. Okay. I'll be sharing some things with you. Do please study them. Okay. Become a consultant, a true one. Because we need Muslims in SAP more than ever. Okay. I have another book to send you, just a moment. Yeah, this is sent to you for now. Yeah, this is enough for you now. For now, I will send more books as we progress. The IFRS book I've sent you, the IFRS notes, and then I will just send you one more thing. That's very important. There are two standards around the world, US GAAP and IFRS. I'm sending you the book also, which actually lets you know what are the key differences between these two. It's a very important one. Okay. This is IAS 37, provisions of long-term liabilities and assets and everything. That's for that. We don't normally do this in FICO. It's a specific task. If you will be going into the company, you will learn this. It's taught on the job. It's not part of the official training. Okay, then we have a reclassify. We have to define this account. Let me show you this. OBYP. We have to define this. What is this? Goods receipt and invoice receipt adjustment accounts. What's happening? If you have goods coming in to the warehouse from the supplier, we have two scenarios. Will the supplier be sending in the invoice first, or will he be sending the goods first? If he'll be sending the invoice first, that's invoice receipt. If he'll be sending the goods first, that's goods receipt. That's GR and IR. Okay. We go here. Invoiced but not yet delivered, and delivered but not yet invoiced. So we define two accounts. Okay. I'm defining the invoiced but not yet delivered, the first one. Continue. We enter the reconciliation account for inventory. We need to create this. So let's begin. Let's create the inventory account, and we have to create it with material management accounts. This one. This is the financial part. There's another account in MM we create. I will show you the path. Choose management. Sorry. We don't have that for reconciliation. I'm sorry for that. And to this, now we have the adjustment and the target account. This would be the overall inventory adjustment. And then we have the target account. So let's begin. We'll create one adjustment account. Sorry, this has a specific one. This has a specific one. Um, this one. Okay, sorry, this one. So in here we have 4, 5, and in here we have this is how it is. Then we have another one. Okay, it's done. Now we move to the next step. The valuation, currency valuation, everything is done. Now we move to the next concept of house banks, bank account. Now, what is a house bank in bank accounting? House bank is the main bank. For example, you have, can I say, we have Mashreq Bank, ENBD. If a company has accounts in a single bank, and then it has bank accounts within that, the main bank account is the one. Then within that, if we have bank accounts, that's within the house bank account. So, for example, if you have Dubai Islamic Bank, within Dubai Islamic Bank, we have different bank accounts. And as per the bank accounts, we could say, okay, you have the main house bank account, and within the bank accounts, the company says we have 3 accounts in the bank. That's the one. So if a company will have corporate account 1, 2, 3, 4, so we create one house bank, and then we create further accounts within that one bank. Okay. So again, FI12, define house banks. A PDIB. So DIB is the only one that's truly Islamic, but let's create. Okay. Now I need to do some configuration on your system. So for you to access Fiori. So on your keyboard, press Window E. Now we move to bank accounts, and when I click bank accounts here, this is the same way it will happen in your system now. You will have to enter the username password I gave you, okay? I will enter my username password in front of you. You will click on create bank account. Once you click on that, you will see a new window. It might be Explorer. You can just cut this. If it is Chrome, then it's fine. If it's not, then you have to just copy, cut, or you can go to Chrome and you will see the following screen coming. Here you will create the bank account. I'm pressing F4 key to actually search. This is EXRG. Bank region is AE. Bank key is this one. We just created, okay? 7CAED. 1, 2, 3, 4, 5, 6, 7, 8, 9, 0. Description. Corporate account. Type. Account. Once this is done, we go here. Add. Now we go here and create this, and we don't do this, then we go here and we select, where is this? Wait a second. Into bank, we have 3. So we will select this one for this balance sheet account. Now, what is the difference? There are 2 things in SAP that has the bank accounts configuration. In real life, we have 2 scenarios: value date and due date. Are you familiar with them? You have the concept that value date is what, and check clearing is value, and due date is the when you have to pay the check. It's the same, no difference. I used the value slash due date, this one, for a simple reason. it will contain both conditions, means all the movement are going to be happening in this account. When I will create a check account, in the checks I will create for incoming checks value date and outgoing checks for due date. Both of them. So I will copy this number and I will enter. It says save. Now what is it saying? GL account is required for bank statement posting. What it means to say is, just a moment. Okay. Yeah, we have this, and yeah, that's it. It's saved, no problem. We need to, we will define more in here. Let me see. Okay, we have the time yet. Back. Okay. This is the bank account that has been created. You want to take a break or it's fine? Should I continue? No problem? Okay, let's move further. Checks. Now we have to do check deposit and check settings. Okay, so we have to define the posting keys and posting rules. So let's begin. The first thing is we go here, define posting key, posting rules. We go inside VXRG. We have to define four symbols. We will define four of them. I have created my own convention. It's your choice. You can create your own. We don't select this. Incoming checks, we have value date. Right. Just okay. Just Let's begin. Now we have defined the symbols. The symbols are for internal use. So we have a bank statement mechanism in SAP. Those bank statement mechanisms, whenever the checks come in, go, bank transfers come, the statement creates lines. Those are called the account symbols. So every bank transaction that goes in and out, it is recorded there, and their impact is recorded accordingly. Okay. So what I have actually done, I have done one thing, but I need to change it to demonstrate to you now how SAP's cash account configuration works. Only one thing I will change. I will show you what. We go here and we create another account. We go here and we create something called the bank reconciliation account. This is what we will create. Observe carefully, this is something that is in SAP S4HANA 2020 only, not any other. So we go here, wait for it, we select bank reconciliation account, cash account, ADIB, recon account. Okay. So bank reconciliation account. Because the house bank will have all the funds, but all the incoming, outgoing checks, bank transfers, movements will create a reconciliation account separate. So we will have both of them to evaluate. So we have, now you know the reason for foreign exchange, okay? This will always post automatically. Again, we select this one for incoming, outgoing, and set it up. This is set up. Now we are going to change the configuration of these. We go here, cash account, bank sub account. Now we select. It's complex, I know, but this is how it works. Okay. VX incoming, VX OC, and VX BN. So, Fiesta. You are understanding. I hope you are, because I'm trying to build everything in sequence. So you have, when you configure, you follow that sequence, you'll be able to configure everything. First, the bank accounting. Posting rule is VXBN 40 for the SA50 posting key we discussed yesterday. VXRG-BNK-IN, BNK-OU. Document type. We have a choice. I think I can create incoming, outgoing both, or we can have a document type directly. We will select we can select AB or SA. I'm selecting SA, posting key, post to GL. That's it. Now we go here, and now we define for incoming and outgoing checks. This is for the bank transfer. It's created. Incoming, outgoing bank transfers going through this. VXIC, subledger accounting, posting key 40, 50. XRG, CHK. It's incoming, so document type SA. Subledger credit incoming, it will show as a credit in your bank account incoming, so it's there. Now we go for VXOC, subledger 50, VXRG-CHK-OU, SA. Understand the point?
Yes.
I normally mix things up, incoming, outgoing bank. It just does, but it's fine. This is a very delicate configuration. We have compression option. In compression, we actually, if certain checks and transfers happen on a single day, if we check the compression, system will accumulate them on a single line. If we do not press compression, then each will have a separate line. So I think compression should not be there. You should have a detailed view, right? So let's have a detailed view. Save. So we have done the check deposit configuration, all of it. Entries. VXRG plus for we just have to create one line for incoming. Posting rule VXIC plus star is we're not maintaining that. In this case, if the bank has told us that we will be clearing your checks on this specific date, we need to enter that here. We haven't configured that. So if you want to do that, we have another configuration. This one. So what happens is ADIB, I think, yeah, AD Yeah. Transaction VXIC, reference date. Okay. Say for example, posting date. Factory calendar ID AE. Factory calendar. We have a T code SCAL. SCAL is the T code for factory calendar management. Factory calendars are something that if we have production happening, if we have any materials coming in, anything, the date control in the CP system is handled with the factory calendar. So this and plus deviation is none. AE alternative rule. Okay, this is as per that date. I say date determined. Incoming checks. Save this. Now we enter this in that. There we have it. The validated calculation is done. Now we go to variance. Variance is there's a check deposit screen. Okay, FF60, FF6, I think it's, yeah, FF68. This is where any check deposits that are coming in, we record them. With the, you see the deposit slip that comes, check deposit has come from the customer, we record the deposit immediately at that date.
Okay.
At the later point when actually the payment comes in, that's when we record the incoming payment. The system clears them both altogether. Okay. So this is the display of the screen. So how many columns we want a customer name like this. So we define this here. Create VXRG. Check deposit variant and insert before. This is a display I'm making for the screen. We have a customer, then the business area is for tracking revenues and profits. Then we have the bank account number and the check number and the amount. I have devised 5 columns. It would depend on the live situation, how the client wants it, and we design it accordingly. We have the fields like this here. So OT45 is the T code for this check deposit variant configuration. Should I continue? Should we keep it to this one? Should I continue more? Let's continue. Okay. Let's go to check down. The bank statement configuration we have done in the bank income transfer. We cannot do electronic because electronic requires integration and connectivity, because in every bank around the world there are specific formats of the document. So we need to map those formats with the banking system, and then whenever the statement comes in, we match, and the system automatically reconciles. So it requires the help from developers and everything. We cannot, as a functional consultant, we cannot directly do that. We ask for the developers to sit with us, and then they do that. So, and it will be asked. So you can explain that in electronic bank statement, we have two things. Okay. So if I show you what those two things are, if I go to bank accounts, house bank, we have VXRG, and we go inside of it. We have these two things, EDI and DME. EDI means electronic data interchange. Electronic data interchange means there is a connection with the system. Electronically, the data is connected and is called on in the system electronically. We connect the system connected to the vendor and the movement happens. Then we have DME, data medium exchange. Okay. DME means that the data is directly requested and it arrives in the system. That's data medium exchange, the direct connectivity. Okay. So EDI is electronic data interchange with the vendor, and DME, data medium exchange, is within that. So with DME, you connect with the bank server and you reconcile in real time. EDI is where you can request from time to time different data. So these both are there in the system in SAP, through which electronic bank statements are configured. So we cannot do that. We communicate with the ABAP developers. They sit with us. Okay, so what should be the format? How do you? So it's like that. But in electronic bank statement, this is how things work. You need to know the posting rules concepts. You have seen them. You should remember them. When you will see the video, you will understand. It's very important. In the interview, they will ask, what are posting rules? What are accounting symbols? How do you connect? So the reason I selected SIP relevant, I selected because the system now S4HANA after 2020 has the capability to auto reconcile. Not before that. Now it auto reconciles. So we have to select SIP relevant. It's necessary. Now we go to cash journal. What is a cash journal? A person that does cash transactions, or the cashier in the company, is the one with the cash journal. Okay, the cashier. So we go here and we define a GL account for them. And a petty cash account. In a company, there can be many cash journals. Okay, the cashier, I will again repeat, the cashier uses this. Okay, he is not allowed to use any others. He will be only seeing an interface for the cash transactions. We have to select this for the cash journal. We cannot do manual postings in that account. It automatically happens. Now there's a system called impressed system. Are you familiar with the word? Impressed system. Impressed system is something like, for example, you give cash to the cashier and say 10,000 or 20,000 AED, and next day you ask him how many are left. He say 2,000. You say okay. You give him 18,000 and not more than that. So he again will have 20. That's called an interest system. It's a way to control cash flow. Okay. We will be defining the limit on the cash journal on a in a live situation on a daily basis. An audit is done. How much cash movement has happened in the cash journal? For that, we have the amount limit. We have to enter that. BXRG, ADD. Yeah. Okay, I made a spelling mistake in there. In the okay. Document types we're going to define. We will be using the document type for cash journal for SA. Now number ranges. Number range again ISO. The number range of the actual cash journal transaction that you will do. The number range of that. Okay, each cash journal transaction that will happen or any posting, that posting will have a number. It's that number, and then we have three kinds of transactions happening. We have check deposits, check receipts, and cash payments. So we have to create three. We have cash receipts, cash payments, and check receipts. Cash receipts, cash payments, and check receipts. We have these three. So we have to create appropriate numbering groups for that. Okay, so let's begin. I have already created, so I will change them as per. And save. Yeah. You. Done that, and now we go back to this, and let's begin. Number range interval first for the cash journal, VXRG intervals 01 and center. Save. Numbering groups. G hash C. So now this is document type. Now we have to define document type for GL posting, SA. Document type for disbursements, SA. Disbursements, an employee comes, he says, okay, sir, I have done that, I have had this as expense. Please give me a disbursement. So he comes to the cashier for that. Then we have payment to the vendor, we have KZ. We have payment from vendor, we have KZ. We have payment to customer from customer, DZ. And DZ. Now for the cash payments, VXRG, cash payments, VXRG, This is, wait a second, I need to see the description. Yeah, this is cash receipts. VXRG, cash receipts. We have check receipts. XRG, check receipts. Now the account authorization group we have, sorry. Authorization group. Authorization group is something we could say, okay, we have authorization to happen in the system, and the authorization group is for authorization grouping. So we specify people who will have access to the cash journal. Okay, that's where we have, it's a security thing, it's not part of functional, but you need to know that authorization groups are there for security purposes. We have employees accessing different parts of an organization. That is part of the field is known as information security. Those are the professionals that have the governance. You have heard the word governance a lot, or not? Governance is controlling the house. In a household, your mother and father are the governance household. They control everything. Okay, they both are one, but you don't realize that they are. Yeah, it happens a lot. It's how the household is running. So that's how it is. I have default configuration done, so I will make a copy of that and I will explain to you what this is. Now, specific transactions to be done to the cash channel. We can't allow everything. So for that, we have this. This is the list. Okay. D is for customer, K is for vendor, B is for bank, cash, receipt from bank account, payment to bank, revenues, cash sales, and any expense. Then we have another thing. This is, now in any of these business transactions, was there cash receipt, cash payment, was there check receipt, or was there both? Cash and check receipt. Okay, this is for cash sales we can use. So we have customer posting. Now it says account modification. We have allowed that. Means we can add any kind of account we want in here. In here we can't do that because these postings will automatically go into the receivables account. And the system will be able to differentiate how, because it will know that the posting was done to the cash journal or to the invoicing. In the reports it will be there. So this is what it is. Okay. Now we save. Okay. Now cash text modification means you can change the text code in the transaction. Okay. Business transaction blocked. If you want to block for a certain time, for a certain reason, you want to block the cash journal from doing certain transaction at any point in time, you can do that. The T code is FBCJC2. Note that down. FBCJC2. This is the business transaction configuration for cash journal. And the transaction to execute the cash journal is called FBCJ. Okay, we have completed major portions of our training today. Next, we will be moving. The bank accounting is finished. Okay, it's all done. And now we will move towards something known as we have done the periodic processing also. Business here. This is we have done these. Now open item clearing. This is the one we're doing for now. This one, prepare automatic clearing. You go inside, and we go to what do we do here? In the system, there is a method for automatic matching from the payment to the invoice. This is a mechanism. We need to enable that. How? We have to copy this function. This is default recommended from SAP. This is the fixed way, and this is how we do it. I will explain each criterion what this is. The criterion 1, this is the assignment. Every transaction that happens in SAP, it has an assignment number. Then we have the business area. Okay. Then we have the purchasing document. Okay. Then we have what we call as the intercompany transaction. So we have these 4 criterions in the system designed. Okay. This for now today completes our training for now. Next I will let you know the schedule, of course, but we will begin from this point onwards, and we will be starting in detail accounts receivable, accounts payable. Okay. Thank you. I will be sharing the video with you now.